Hello, welcome to this video. I'm Milind Date and I'm the expert tutor for the AFM examination. In this video, I would be covering some important aspects about working capital management. Please note that this video is not a teaching video, but it would give you some insights into how this topic is tested by the examiner and some tips towards how to prepare for it and what care you should take when writing your answers. So before we dive deep into it, let us look at how this topic is included in the AFM examination syllabus as such. Well, working capital management is covered in section C of the AFM syllabus. And in particular, it deals with the nature and elements of working capital, manage how the company manages different components of the working capital, and determining its needs together with the funding strategies. Therefore, if you look at the scope of learning, it's clearly set out in the learning objectives. Overall, the students will be tested using the question verbs such as describe, identify, discuss, explain, evaluate, or calculate when it comes to constructive response question. Obviously, different types of objective type questions also can be set on this topic very well. And therefore, students will definitely be encouraged to learn the requirements of various verbs used, along, of course, with the intellectual levels being tested. This video in particular is meant to provide you all with an overview of various decision areas of working capital management. And it will also cover a small little bit of brief on how various components and decision tools related to working capital management are to be learned. You'll find this learning in the chapter number 13 of the ACCA Study Hub. And today's video in particular includes the material from subsection 5 of the chapter 13 of the ACCA Study Hub. So how is this topic likely to be tested? As you're aware, the AFM examination is split into 3 sections, wherein sections A and B are devoted differently though, but to the objective type question setting, and section C of the examination deals with the constructive response questions. Under the approach to examining syllabus of the AFM, it has been clarified that 20 marks questions in the section C will mainly come from working capital management, investment appraisal, and business finance areas of the syllabus. And therefore, please note that this entire topic qualifies to be a full 20 marks question in section C. Of course, it's already clear that sections A and section B of the examination can come from, questions can come from any syllabus area. So your preparation has to be considering these facts, that this particular topic is tested in any section of the examination, either in the form of OTQs or CR type questions. So the essential part of learning on this topic will definitely include in-depth understanding of all the concepts. The reason being, there will not be any direct memory testing question in the CR type questions, nor a very straightforward looking objective type questions. It will essentially include application of what you have learned. So with that set of mind, you should be able to look at how working capital management needs to be learned for FM examination. What is working capital management? Basically, of course, it relates to balancing of liquidity versus profitability. Now, liquidity, of course, of any organization refers to company's ability to meet its obligations when they're due, of course, in the short run. And profitability, on the other hand, refers to company's ability to use the resources to generate profits, generate wealth. The second aspect of working capital management is related to managing different components of working capital. What makes a working capital as a totality? There are different components thereof, and how the company manages each of those components will dictate in all how the company is able to manage its total working capital. So the components put together form operating cycle of the organization's working capital. Operating cycle, in fact, refers to the length of time taken by the organization to convert its spendings on raw material, labor, overheads back to cash. So many times it's also referred to as cash operating cycle of the company. The working capital and its components are basically split into two parts, as you are quite very well aware: current assets and current liabilities. Whereas current assets includes important components like inventory, receivables, and cash. Remember, these are the basic components. Don't misunderstand this with prepaid expenses, which accounting wise, although forming part of current assets, not much needs to be done to manage them as such. Same thing is with the provisions as a component of current liabilities. So basically, when we are talking about current liabilities, we are dealing with payables and overdraft. Every organization has to see the proficient management of working capital. It is really very vital for its success, and therefore companies must lay down clear and effective policies for each component of the working capital. And that's what exactly you need to learn to be able to tackle examination questions. The decisions which need to be taken for managing working capital successfully may be related to forming an optimum level of investments in the current assets. How much should a company invest into current assets? Meaning, in other words, what level of inventory should it keep? How much amount at the max can be blocked in terms of receivables? And how much cash and bank balances should a company carry at any point in time? It also leads to development of certain tools that should be used by an organization to manage these different components of current assets. And naturally, if you want to build those levels of current assets, where will the money come from? So the next decision that is to be taken is how should the company fund these current assets? Well, there is no standard carte blanche answer for this or these questions, because your decisions will essentially be affected by the nature of your business, the terms of trade, the payment terms, and the company's policy, whether the company management is going to pursue an aggressive working capital policy or a conservative policy. So there are two ingredients of total working capital policy, and this area may be tested in section C of the examination with a CR type question. Working capital investment policy and working capital financing policy. Investment policy refers to the levels of current assets to be maintained, and financing policy refers to the levels of current liabilities that it should maintain. But the gap between the two needs to be funded from outside sources. And as I said, these policies could be either aggressive or conservative. The conservative policy, you please learn very well that it tends to maintain high level of liquidity and therefore high level of current assets. Whereas an aggressive policy prefers focusing on profitability. So very low level of current assets they would like to maintain and use short-term funding even for the permanent type of working capital. Now, whether the combination of aggressive investment policy and a conservative financing policy or vice versa would be suitable, feasible, acceptable for a given scenario or not, that may be the type of question that examiner may ask you. Or the examiner may provide you with the financial statements over a period of time, maybe more than a year or two, and then try and make you comment on whether the company has an aggressive or a conservative investment as well as financing policies, and what are the implications of that for the company. Very, very important piece of information that's I'm covering at the moment, which qualifies for a constructive response type question. Please prepare for this very well. Components of current assets, as I said, comprise of inventory, which is raw materials, work in process, finished products, parts. When you carry inventory, you must understand what are the costs incurred for carrying that inventory, holding that inventory. These understanding will help you in doing your quick calculations about the concepts like EOQ, economic ordering quantity, storage costs, stores administration costs, losses due to theft, obsolescence, financing cost for funding the for money raised for funding the levels of current assets. Receivables, well, the level of receivables will be largely dictated by the fact that credit has to be offered to the customers based on the industry norms. And there are key areas of assessing creditworthiness, setting the credit terms, and monitor the cash collection process. Company must ensure that its actions help limit the debt becoming non-collectible. There is no doubt that credit will help the companies increase their revenue, but companies must not relax regarding collection from the customer. The longer it takes you to collect the money, greater is the risk of it becoming bad, and therefore greater the risk of facing liquidity issues. Payables, on the other hand, are supplier credit that provides you sort of funding for at least a short term. It largely helps companies to manage their cash flows. The cost of obtaining a credit from suppliers is like an opportunity cost of foregoing early payment discounts. So a cash price for any supplier will be lesser than the price that you pay for obtaining credit. One indirect cost of payables is always, credit worthiness and the effect effect on rather of credit worthiness of the company. If company consistently delays payments to its customers, it may affect relationships. Now, in the last 3-4 slides, whatever I have spoken, you must learn very carefully. Try and apply these findings to different scenarios to assess whether the company is going to face liquidity crunch in coming times. Cash and bank balances, matching of inflows with outflows is very critical for liquidity. You shouldn't have a situation where you're always thirsty of cash. Companies therefore use techniques like cash flow budgeting to avoid running out of cash or to even have surpluses which may result in idle cash lying with you. Naturally, depending on the nature of business, cash flows may be regular or irregular. The management skills become much more apparent in case your cash flows are irregular, and therefore care has to be taken to ensure that there are no large gaps when you manage cash and bank balances as such. While large companies generally find it relatively easier to manage their working capital, there are typical set of problems faced by small businesses and also by the startups. Startups, for example, the growth is very fast. And if business keeps growing, they keep requiring more and more cash to buy more inventory, to buy more supplies, to pay to the labor, etc. For small businesses, the credit granted will keep generating sales for you, no doubt, but will keep cash blocked into receivables. And initially, therefore, they will have to depend to a large extent on short-term finances. The problem, therefore, could be a bit complicated when we talk about the small businesses or startups. Of course, the primary cause is the faster growth rates in the initial period. But at the same time, the startups especially will have lower credit standing to get attractive terms from their suppliers. And therefore, they may face longer operating cycles, which may not be good to support their growth. And that's something which one will have to keep in mind when, providing answers to a constructive response type question. One very important situation in which companies often find themselves is the situation of overtrading. The another word used for this situation is undercapitalization. So this actually can happen in a situation where company supports the growth with the least possible amount of working capital base. Very low level of inventory, very low level of receivables. It's good to have that situation, but if you are unable to support high growth sales revenue, then it becomes problematic. So potentially, this can ultimately lead to liquidity issues for the company. So there are certain indicators we can tell you whether the company is actually overtrading or it it's undercapitalized. And some of the very commonly known indicators or signals could be reduced liquidity, which I said just a few seconds ago, rapid growth in revenue, and that too at lesser margins, which leaves lesser cash, of course, available with the company. Higher inventory holding and receivable periods. I'm not talking levels of these current assets, but the periods. So inventory is moving slowly. Debtors, receivables are being collected slowly. Now, higher number of days holding periods will have an impact of pushing the operating cycle up, and this would, lead to ultimately liquidity issues for the company. On the other hand, a company may have therefore to raise money using borrowings, both long-term as well as short-term. Now, it's kind of a scenario given to you in section C type questions. And just a one-liner question may be asked to you, identify or evaluate whether the company is overtrading. You will get support from the numbers in financial statements, plus some of the qualitative information that is provided to you. But what you need to do is to use your interpretive skills. You can't just copy paste from the scenario and just state a few numbers here and there, calculate few ratios. Calculations is not going to give you marks. The interpretation and the outcome and the impact of your observations on the company's liquidity position is what is going to give you marks. So again, notice whether the company in the scenario given to you is a startup or is a company that is serving a very niche market where demand increases very fast. These companies generally will always be cash thirsty. And therefore, they are compelled to resort to excessive fund raising to meet their growth targets. This will push up, of course, finance costs. And the situation definitely will reach such a level where you will have to correct it by addressing the signals. And that's not going to be easy. I personally think that working capital management is one of the most difficult tasks in the job of a finance manager for any company for that matter. So learning this will not only help to get good pass in this paper, but also to be able to get workplace readiness post qualification. Let's look at how is this topic tested. Now, if you consider component management, inventory, receivables, cash bank, payables, generally you will find objective type questions on each of them, calculation type questions on each of them. But what we discussed just now, especially the undercapitalization, overtrading, working capital aggressive or conservative policies for investment as well as funding, both these typically could be questioned in a CR type. You will be given a lot of financial information for more than 1 year. You are expected to use this information to calculate relevant ratios only. I mean, don't just go on calculating ratios just because you know how to calculate them. Check whether they are relevant with respect to the task that you are supposed to perform. And then use them, interpret them for commenting upon the signals to conclude whether the company is overtrading or not. So a CR type question, will involve, as I said, calculation of ratios and then arguments based on the interpretation of the ratios, whether the company is overtrading or not. You will generally get the data in terms of financial statements for more than one accounting period, some qualitative information, and maybe at times comparative numbers you will get from competitors or industry average as such. And your answer plan, this is very critical. Check first the number of marks reserved for calculations. Many times I have seen from my experience in the past examination, the examiner provides a hint. Say, for example, up to 4 marks are reserved for calculation, maybe out of 20. So even if you give calculations very correctly, but concentrate only on calculations and give 20 ratios, what you are going to get maximum is 4 marks. And you will be left with no time, unfortunately, to, concentrate on the qualitative part of your answer. Once you do the calculations, focus on the signals such as revenue growth. Is it too fast, too slow? Are the profits declining or rising? Is the company experiencing raise in the borrowing amounts? Is the current ratio dipping? Any dipping current ratio will not be a good sign so far as liquidity is concerned. And all these observations must be articulated very well with the support of ratios. And then based on that, you should be able to form conclusion whether or not the company is overtrading. Well, as I said, this video doesn't aim to talk about management of components. It aims to talk about the policy level decision making in terms of working capital investment, in terms of working capital financing, and in terms of addressing or rectifying the situation of overtrading if at all the company is experiencing it at a given point in time. It's towards this that it's important for us to look at the observations which examiner makes from the analysis of answers given by the students. Look at these. The candidates keep on calculating accounting ratios one by one. But while commenting what they say, state simply if the ratio has gone up or down, and if they were different from the average values or not. Now, this is not going to get marks. You must move up from being able to just calculate the ratios to being able to interpret what the ratios are saying, either individually or collectively. Another comment which the examiner has found out says that weaker answers only calculated accounting ratios for 1 year, while some candidates wrongly assumed that average values from similar companies were accounting ratios for the company in question. Now these are weak signs of students who are not appropriately prepared. So therefore, you must learn very well from ACCA Study Hub and other resources that are available to you. Once you learn the concepts from the Study Hub, please make sure that you make use of the quizzes and practice questions available there, and then concentrate on questions from past examinations that are available to you in the practice platform. And don't ignore the comments of examiner. For working capital management, as I said, you can refer to chapter 16, practice the OTQs from quizzes and CR type questions from the practice tab of the Study Hub, and then may go on using ACCA practice platform for additional practice, rigorous practice, which is exam oriented. Taking mock exam, of course, is going to immensely help you to ensure a pass. So in this summary, what have we discussed in this video is what working capital is made of, how to achieve optimum level by ensuring appropriate policies of investing and funding working capital, avoiding situations like overtrading, how this topic is typically tested in section C using the CR type questions. So that's it from me. Thank you very much for watching this video, and all the best for your learning and future exams. Thank you.